Hello Guyanese citizens. In this video, we want to compare the Guyana 2016 oil contract with Suriname 2011 oil contract. Suriname is a good benchmark to use as it is our next door neighbor, and our oil blocks are close to each other in the same areas of the ocean offshore. The contracts for Guyana and Suriname appear similar in form, but they are vastly different in the following 7 key areas. 1. The first area is import duties. Import duties are taxes paid on goods brought into Guyana from another country. Goods can be raw materials which are brought in for the purpose of constructing a supermarket or equipment to build roads. The import duties are paid by the person or businesses that are bringing the goods into Guyana. For example, steel pipes used for building a supermarket would be taxed through import duties. The tax rate from import duties range from 5 to 150%, depending on if it's raw material or a finished good. 2. The second area is royalty payments. These are payments made by companies to the people of Guyana for the ownership rights and the use of our natural resources. In the case of the oil and gas industry, these are payments made to the people of Guyana by Exxon, Hess, and CNOOC, which is the China National Offshore Oil Corporation, now operating in the Stabroek oil block. Usually, royalty is a percentage of the quantity of the oil produced. The third area is capital cost recovery. Capital are items such as machinery or equipment that are bought and used by oil companies in the production of crude oil. Capital can be floating, production, and storage offloading ships. In the Guyana oil contract, capital cost recovery and other operating costs are deducted at a maximum of 75% of gross revenue of oil produced and sold by the companies. The fourth area is taxation of profits. After the company pays off all its expenses from its total gross income, whatever is left is the net income or profits. The government collects income tax from individuals or businesses on the net income or profits. The income tax rate is typically 40% for commercial companies. For example, a company that has earnings of $100 million would pay income tax of $40 million to the Guyana Revenue Authority. The fifth area is corporate social responsibility. This is a commitment between the government of Guyana and the oil and gas companies for companies to positively contribute to the development of the human capital in Guyana through technical training, jobs, culture, sports, and arts. The sixth area is environmental responsibility. This is a commitment by companies to protect the natural environment in which they operate, such as protecting the fishing industry from hazardous waste from the oil production process and reducing gas flaring to acceptable pilot levels. As we know, flaring can cause damage to humans, plants, and animals. The seventh area is insurance. This is a guarantee of protection or compensation in the event of accidental loss, death, or damage to the environment. So let's look at the comparison of current Guyana and Suriname oil contracts. We will look at the financial areas of both Guyana and Suriname. First, in the area of import duties, both Guyana and Suriname is exempted. In the area of royalty payments, Guyana gets 2% of gross income, while Suriname gets 6.25% of gross income. In the area of capital cost recovery, Guyana pays 75% of gross income to the oil companies, whilst Suriname pays 80% of the gross income to the oil companies. In the area of taxation of profits, in Guyana, oil companies pay 0%, but other companies in Guyana pay 40%. In Suriname, all companies pay 36% taxes on profit. In the area of environmental responsibility, any liability is Guyana's. In Suriname, oil companies have liability. In the area of insurance, any liability is Guyana's, whilst in Suriname, oil companies have liability. Conclusions and recommendations. For the Liza 1 well in Stabroek Block, while the projected average take for Guyana would be less than 14.5% of revenues, in Suriname it is estimated at 36%. Guyana collects no income tax on oil companies' profit, but Suriname collects taxes at a rate of 36%. Overall, Suriname's contract yields a higher income than Guyana's income. Guyana's risk to exposure to environmental loss is significant given the current lack of protections in place, for which it is not clear if there is adequate insurance. In the event of an oil spill, Guyana will be liable for cleaning the spill, which could leave the country in financial ruin and permanent environmental damage. Guyana received a signing bonus of $18 million for the Stabroek Block, which has 9 billion barrels of oil in proven reserves, whereas Suriname received $100 million for its Block 58, which has 0 proven reserves. Suriname's government's company called Taxation has participation rights in developing Suriname's oil blocks. The government of Guyana does not have any participation rights in developing its oil blocks. OGGN recommends that since Guyana currently does not have the capability or capacity to monitor, audit, or verify the amounts of oil that is produced and sold, Guyana should move to a revenue sharing model to save on auditing costs and reduce the need to micromanage the entire production process. This would simplify the oil contracts such that Guyana is beneficiary of more than the revenues generated.